Have you ever wondered how some people seem to get rich overnight in the stock market? Are you aware of the dark side lurking behind those enticing stock tips? Today, we're diving into the shocking truth about stock market scams and manipulations that could cost you everything. Buckle up, because this is a topic every investor needs to understand. Let's start by defining what stock market manipulation really is. Stock market manipulation refers to actions taken to artificially influence the price of stocks for personal gain. This can include deceptive practices designed to mislead investors and create false market conditions. Manipulators can use a variety of tactics, often exploiting the psychology of fear and greed to their advantage. Now, let's explore some common types of scams you should be aware of. Pump and dump. This notorious scam involves artificially inflating the price of a stock by spreading false or misleading information. Scammers create a buzz through aggressive marketing tactics or social media hype. Once the stock price peaks, they sell off their shares, leaving unsuspecting investors with significant losses when the price crashes. Churning. In this practice, brokers excessively trade a stock to generate commissions. They may recommend unnecessary trades to clients, which increases their fees while potentially leading to losses for the investors. Churning is unethical and often illegal, yet it still occurs, particularly in less regulated environments. Front-running. This unethical practice happens when brokers buy stocks for themselves before executing orders for their clients. By doing this, they profit from the price increase that results from their clients' orders. Front-running erodes trust in the financial system and highlights the need for regulatory oversight to protect investors. Wash trading. This involves buying and selling the same stock simultaneously to create the illusion of high trading volume. This can mislead other investors into thinking a stock is in high demand, driving up its price. Wash trading is illegal but can be difficult to detect, making it a favorite among unscrupulous traders. Short-selling manipulation. This involves spreading false information to drive down a stock's price, allowing manipulators to profit from short selling. This can create panic among investors, leading them to sell their shares at a loss while the manipulators buy them at a lower price. Let's take a look at some notorious cases of manipulation and scams in the stock market. Enron. Enron is one of the most infamous cases of corporate fraud in history. The company used accounting loopholes and special-purpose entities to hide debt and inflate profits. When the truth was revealed, Enron's stock price plummeted, leading to billions in losses for investors and employees, and ultimately resulting in bankruptcy. The 2008 financial crisis. Many banks engaged in risky practices, including misleading reporting on mortgage-backed securities. This lack of transparency contributed to the global financial meltdown, leading to widespread economic hardship and loss of savings for millions of people. The crisis highlighted the need for stricter regulations to protect consumers and restore trust in financial institutions. GameStop short squeeze. In early 2021, a group of retail investors on the Reddit forum Wall Street Bets banded together to drive up the price of GameStop stock, which had been heavily shorted by institutional investors. This collective action disrupted traditional market dynamics, leading to massive losses for short sellers and raising questions about market manipulation and the power of retail investors. Now that we understand some of the scams and historical examples, let's talk about how you can protect yourself from falling victim to these tactics. Do your research. Always investigate a company's fundamentals before investing. Look at financial statements, company performance, and industry trends. Utilize reliable financial news sources and analytical tools to gather information. Be skeptical of hype. If something sounds too good to be true, it probably is. Be wary of unsolicited investment advice, especially from unknown sources. Social media can be a breeding ground for scams, so approach any investment opportunity that seems overly hyped with caution. Diversify your investments. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes to mitigate risks. A well-diversified portfolio can help protect you against significant losses from individual stocks or market downturns. Stay informed. Keep up with financial news and market trends to recognize warning signs of manipulation. Subscribe to reputable financial newsletters, listen to investment podcasts, and participate in online communities focused on responsible investing. Use trusted platforms. When trading stocks, use reputable and regulated brokerage firms. Research their track record and read reviews from other investors. Ensure that the platform has adequate security measures in place to protect your investments. Understand market dynamics. Learn how the stock market works, including the role of institutional investors, market makers, and regulatory bodies. Understanding these dynamics can help you make more informed investment decisions and spot potential red flags. Consult financial advisors. If you're unsure about your investment strategy or feel overwhelmed, consider consulting a financial advisor. They can provide personalized advice based on your financial goals and risk tolerance, helping you navigate the complexities of the stock market. The stock market isn't just a place for wealth building. It can also be a minefield of scams and manipulation. It's essential to stay informed and vigilant to protect your investments and financial future. If you found this video eye-opening, give it a thumbs up, subscribe, and share your thoughts in the comments below. Have you ever encountered any scams? Until next time, stay vigilant and invest wisely.